at a share price of $301, for me, I think it works out a 350 bagger.
Wow.
I'm not the guy that like picked the 300 bagger. I'm the guy that picked 10 stocks and one of them was a 300 bagger.
Yeah.
Absolutely right now thinking about the overall takeaways from earnings season. We're in a bull market.
Nice.
To add to your message that anyone can invest, my message that I want to add on top of that for this episode is, and you should try to invest in the style that suits your personality.
What's your personality and how does that translate into an investing
Yeah,
style?
great. Okay, we get to talk about myself. Well, probably how do you spot those people that are really the people that are most worth backing?
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, we have a huge episode for you today. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are joined by a returning guest, someone who swims in very similar waters to us, I guess, Australian financial media or online financial media. He's a much better investor than us. So
Yeah,
I
safe
think
to
it's
say.
safe to say. So we're excited to pick his brains. We were just chatting before we started recording, and he said he's been knee deep in reporting season. So we're excited to hear what he's learned. Claude Walker, welcome back to Equity Mates.
Thank you so much for having me. It's great to be here. Although I'm not so sure I necessarily am a much better investor. I've heard you guys talk about your long-term returns, and I think you're doing very well. And
so we don't have any 100 baggers in our portfolio, but we will get to that. Now, Claude, you're the founder of A Rich Life. That's the project you're working on now. But for people who aren't online and have seen you across your different platforms over the years, do you want to just quickly introduce yourself and then tell us a little bit about The Rich Life?
So I am, a kid that just grew up not knowing what I wanted to do when I grew up, like when I got older and when I had to get a job. So I sort of mindlessly, because I had the marks for it, did a law degree, which turned out to be useless or like sort of useless anyway. And so I got to the end of it, I got my first class honors and I started going down the path of trying to be a lawyer. And then, as soon as that happened, I was like, oh no, I can't do a lifetime of this. And so, that forced me to step back and think about like, what am I passionate about? And the things that I really like cared about as a young person, which is still what I like today, which is like nature, I guess, and the environment was one big thing for me. And also investing. I don't know why, but it's like goes back to like childhood. I remember, my dad worked very hard and I didn't necessarily see him that often. And I had another friend whose dad's always picking him up and in his nice car and just didn't seem to be working. And I remember asking one time to my dad, what's his job, And dad was like, I don't know. I think he made a lot of money buying and selling shares. And that just like lodged into my brain as like an 8-year-old or 10-year-old or something. And it never went away. I was like, that could be a good life. Anyway, so fast forward that I got my first proper job at Motley Fool. I was the advisor for Motley Fool Hidden Gems for a couple of years and the analyst as well. And that was, a great opportunity that I loved and I took extremely seriously. And it was also scary to be giving, when I was still quite young in my mid-20s, recommendations to people. And because Motley Fool was, such a marketing beast, we had, I probably can't say the actual numbers, but we had a lot of subscribers and we were moving and to the point where I was like, we cannot have any more subscribers in this service because, as a 27-year-old, I'd say buy and then the stock would move like a lot. And like 10% was sort of standard almost.
Really?
Yeah.
Wow.
So you can see how that shaped my way of investing because when I'm there and I'm like, I'm going to say buy. So for example, to use the example that I'm sure we'll talk about later, ProMedicus, when I was looking at that, when I put out the buy recommendation from memory, it was like about $1.34 or $1.35. And then when it closed that day, it was at $1.54. And so that obviously you start the score from where you after you rec. You don't say, oh, it was this before our recommendation, so aren't I great that it went up? No, you take the starting price from when the day after you've recommended it.
Okay.
So I was very conscious that in order to win, I needed to be making stock picks that were good enough to...
After a 10%.
I'm going to lose 10% out the gate. So that like sort of pushed me towards, I guess, higher risk reward stuff. Because if your expected return is like, 15% a year, then a 10% hit is a lot. So then, of course, when you go out and do higher risk reward, you get bigger blow ups as well, and it takes a massive emotional toll on me. And that's probably the hardest thing about what I do. After a few years of that, I actually took some time out to do something completely a little bit different from actual stock pickings and worked for a company called Simply Wall Street for a bit more than a year. And so I'm really sorry, everyone, for all of the automated content that I'm partly responsible for. That was like well before AI. So that was like their thing, is that they, this is when I first met you actually, that we're just creating a lot of content that was like automatically done, not AI. Just I coded it all, if this, then you say this. And, my big mission was to make that content better. And then I basically, in the process of that, me and some of the other people, they sort of designed a better system for doing that could give, in our view, better results for the readers. But Simply Wall Street wasn't going to change that system. So then a few of us left the company, and I just for a short amount of time worked on, and that was when I started A Rich Life. But at the same time I was starting A Rich Life, I was also helping my friends launch this other company called Stock Story, which was the one I told you guys about in the last time I came on this show 4 years ago. You asked me what my favorite company was, and so stupid. Instead of me like telling you like my favorite stock in my portfolio, I told you about some private business that I was working on. But that's just a passion of mine, I guess, to try and help people invest better. And when you're creating automated content, if it's good and if it does help people, then you really can make a difference. But of course, the challenge is to actually make automated content good, which is not so easy. Anyway, I moved away from that to focus on A Rich Life. And after a couple of years of building that up, we started doing official recommendations, like buy, sell recommendations at A Rich Life, where I write about stocks, and we have a bunch of other writers that do as well. Have a couple of other writers that write about news and art stuff as well. So it's not just stocks, but that's, partly just because as a news website, you do better if you've got multiple sort of different bits of content coming out constantly, rather than just being too niche and too slow. Whereas I'll only come up with a buy recommendation once in a while. So started doing that. That's gone pretty well since then. As of June, I should have updated my returns actually, but as of June, we were going at like 28% per annum on the recommendations if you followed them the day afterwards or at the close afterwards. And that doesn't include brokerage, by the way. But also since then, we've had a great reporting season. So the return would be higher than that now.
Nice. Well, we're going to jump into the reporting season in a moment, but the Motley Fool has been pretty successful at building pretty successful analysts, particularly known to the Equity Mates community. Owen, Andrew Page, yourself, Scott Phillips. Going into the Motley Fool, did you have an investment style, or was your investment style built while at the Motley Fool? And how would you describe your sort of style and philosophy today?
Yeah, it's a great question. Because it picks up on that nuance that, like, I guess one's style is always changing. So that was at the beginning of my journey. I'd already certainly understood some things then that I still believe now and that shape it now. So, for example, I actually bought ProMedicus shares before I even got my job at the Motley Fool. So I already owned shares in that and like brought it to them as like, hey, this is the one I want to recommend, and sort of argued for that. And I continue to develop my style, but I would say what Motley Fool does really well is they allow the analysts to develop their styles. It's in the name Motley, and that's the most important part of it for me, because that allowed me to try and develop and find the style of investing that played to my strengths, which is actually a theme that I'd love to emphasize a lot in this, because I think to add to your message that anyone can invest, my message that I want to add on top of that for this episode is, and you should try to invest in the style that suits your personality, like play to your strengths. So the way that I should invest, my strengths might be something completely different from somebody else. And therefore, the wins that we're likely to get could be on completely different stocks, but they still could be both wins.
Yeah. Plenty of ways to make money in the market.
Yeah, exactly. So
what's your personality, and how does that translate into an investing style?
Great. Okay, we get to talk about myself. Well, probably my friends and wife might have a different take on my personality. But if we're going to be real for a second, like I have severe ADHD and have been diagnosed with that multiple times in my life because I am very inconsistent with like ever actually wanting to treat my ADHD. And then, of course, I lose the old diagnosis or whatever. Like I don't have any evidence of it. So because of that, I think that style really lends itself to small caps because they're exciting. Like it's never boring. Like there's always stuff happening. You're not like, oh, earnings were up 4% and the share price moved up 2%. It's like, earnings were up 100% and the share price moved up 80%, or not 80, but like 20% on results. Like these results, I've had, a number of 15% plus moves up. And yesterday, unfortunately, we had a couple of 8% moves down on results. And I said that to my dad and he's like, what? And I'm like, no, that's just standard for me. Like that's a normal day in earnings season, like these huge emotional swings. So I think that pushed me towards small caps, all that kind of excitement. And then also that's really good for wanting to turn over a lot of rocks. So people ask me, oh, what's idea generation or whatever? Like, actually, it sort of just gotten to the point where I just look at everything. Like, it's like, an ADHD bunny. Like, yeah. And of course, there are things that you do that means that for some things you look at it for 1 second, like mining company, out the door, biotech, except for very rare extensions, out the door, lacking at least, say, about 4 or 5 million revenue, mostly out the door. Except if you might look at a quarter, and if the latest quarter was suddenly 2 million and they're run rating like 8 million, then I'd be interested. And I'd potentially go lower if you're seeing that growth. But revenue and industry are the biggest cutoffs. And then after that, if they're too big, is a cutoff for me. Like, so I've left.
No CBA.
Yeah. Well,
what's too big?
Well, so now in my portfolio, I do have a number of too big ones now. But for me, a classic example of what's too big is REA Group.
Okay.
So I basically ignored that back when I first started investing in investing seriously in like maybe 2013 or something like that. I looked and I thought, oh, this is a great company. It's blah, blah, blah. Like, but I'm looking for something that people haven't discovered yet, that's like under the radar. Like I'm not going to be better than all of the analysts covering REA Group that know all the people and they've got all the nuances and the spreadsheet that they work on every year and probably get management to check. No chance. I just ignored it. But like in a way, that's a bit of a mistake, right? Yeah, I actually own REA Group shares now but mostly just psychologically, I'm like, oh, it just pisses me off to watch it go up. Like, why does Australia have a housing bubble? Like, how come I'm not making money off it? Like, so where's my style? Ultimately, what I'm looking for the long-term stuff, I'll do opportunistic stuff. So as part of my portfolio, if I see a shorter term thesis or a sociological thesis, I will do short-term or lower conviction stuff because that's part of the pipeline that leads me to what I'm really looking for and where all my real money is, which is at a high level, high quality business, which we've got to delve into, honest, competent management, and plenty of room to grow. And the high quality business, a lot of people have a different idea of what a high quality business is than I do. So a lot of the work goes into trying to figure out if the business is indeed high quality. Usually it's quite easy to figure out how far they have to grow in their market or whatever. And then the other thing where I put in a lot of work, which is what I talked about last time I was here 4 years ago, is management quality. And I think that's where I can get my edge. Because if we go back to that background in a legal degree, so my dad's a barrister and sort of taught me about cross-examining and stuff and like the things you can do essentially to see if people are, how honest they're being and how frank they're being. And that's where I feel like I can get my edge. So I put a lot of time into that.
Well, let's stick on that. Your criteria, those three things: high quality business, honest, competent management, room to grow. And let's start on honest, competent management because you were just talking about it there. You say that you've got this edge because you can cross-examine management and stuff like that. But like, is that what you're doing? Are you speaking to management, or like where are you finding information on if they're honest and if they're competent?
So a lot of people in society, probably you guys, most people in society have a natural ability that they've honed through their own personal relationships. It's like figuring out whether they trust somebody, right? But what you have in stock markets is that the people who are, the wise wizards that tell everyone, what the company's worth, most of those people, I would say 98% of those people have a ton of incentives, which means that they have to suck up to management. And sucking up to management means that their career progresses. Because whether it be, how many funds have you seen? You read the report. We had 57 management meetings. And they do it because they want to tell their little investors, oh, I'm so much grander than you. I have access to management. You could never do what I do. That's why you invest in my fund. I've had, 110 management meetings this year or whatever. Okay, so how do you get those management meetings? Well, by being nice to management. You're not going to, it doesn't matter if you're a fund, unless you actually own a massive chunk of the shares. If you're just researching for a fund and you're asking questions on the conference call or privately that are skeptical and suggest that you're really testing management and doing litmus tests on them, they'll very quickly be I'm just going to not talk to that person. And same goes for brokers. You see it. You see old mate Chris, whatever his name is, Ellison at Min Resources, punishing the analyst who was skeptical and saying the stock was a sell when it was a sell, and taking away the access. What? Now, that analyst, good on him, first of all. And second of all, that is the exact kind of analyst that people should listen to. And I hope as a result of him being proven right and now getting access again, his career goes to the absolute moon. But most analysts are not willing to do that, or they don't have enough security within their organization to actually take on one of these big CEOs and risk their wrath. So that means structurally across the whole industry, all analysts have incentives, even myself, to play nice and not ask tough questions and not call them out when they've done something that does seem dodgy. And this even happened to me at Motley Fool right now. Again, to their credit, I didn't get punished for it, but a company that had done something, in my opinion, essentially, they'd basically been earning revenue that had zero profitability to it, no gross margin, but then they didn't tell people that for years. Right. And then when that got found out, I was like, what? And gave them a pretty bit of a bollocking on the conference call. And because in those days, I was moving markets, I don't really anymore, but on the call, just when I started talking to them, the stock started diving.
Oh, wow.
And then sure enough, I downgraded it to hold or whatever. My skepticism, just people were this is bad. And then as a result of that, it got back to me that company had refused to talk to the fund that Motley Fool ran that was completely separate people, different name, everything. And they'd refused to talk to them because I'd done that,
wow.
Which just shows you how companies enforce analysts basically not asking hard questions. And if you can't ask hard questions, if you can't test someone, if you're not willing to risk this guy not liking you, you're at a massive disadvantage when you're trying to figure out if he's telling you the truth or how frank they're being.
So that means that you can't look at third-party analysis of management to assess if they're honest and competent. So what do you use to assess them?
Well, so you basically just got to do imagine you're skeptical, you're reading everything they wrote, you read past stuff. And this is actually another thing why it's hard to do, is the only way you can really tell, I've found out over the years, it's contemporaneously following the stock, right? You can do it when there's obvious cases of people doing dodgy stuff. You can look back at the history and say, oh, in 2014 they said this, and then in 2015 they said that, and then it keeps on changing. It's unreliable, so we shouldn't rely. You can do that sometimes when it's obvious, but that's when you're trying to root out the bad ones. What's actually more of an art, which I'm still trying to figure out and get better at, is how do you spot those people that are really the people that are most worth backing? And for me, I'm looking for acts of unrequired integrity that might prima facie be against their interests. So I'll give you an example. Years ago, before the ProMedicus founders first sold any shares. Now, they're not in this habit of doing this anymore, but years ago when it was a smaller company, it was more likely that their share sales would have an impact on the market. Before they sold any shares, announced, we are planning to sell shares, over the next 3 years, we're going to sell shares once a year or something like that. I can't remember what the exact thing they said was, but they basically for pre-broadcast their plan to sell shares, not just tomorrow, but over the next few years at a certain rate, et cetera, et cetera. So that was out in the market. Now, hypothetically, all else being equal, telling people you're going to sell, not just today, but also in a year and another year past that, hypothetically, that is against your interests because it means that people might pay a lower price for your shares today, thinking, oh, you'll sell more later. But they did it anyway. And so for me, that was a sign of like, that's just like a high integrity thing to do. The typical one that's the easiest to spot is like, do people do what they say they do? Are they conservative in their outlook? So like another high integrity thing that is quite rare, which I'm a huge fan of, is not giving guidance. Analysts want guidance, right? So they can fill out their spreadsheet because they're getting marked on how close am I to the earnings that, I predicted. And so they really want you to give guidance. And so if you want to have the analysts being, buy this stock, it's good to give guidance and yada, yada. And look, it's pretty reasonable. If you're always giving guidance and you're always just being a little bit conservative and always just coming in above, that's fine. But the highest, you can't always control that. The highest integrity thing to do is just not give guidance. You can say you can give them information so that analysts can make a good guess, for sure, but not to say, hey, we're going to make this exact number. And so that's like a less promotional things to do that makes it harder for those management on a day-to-day. They have a harder relationship with the analysts, more people bugging them, but they'll do it anyway. So that's a good one. You see that with a few companies.
Interesting. So honest, competent management is one of the criteria for a winning small cap. You mentioned high quality business and room to grow. So let's go to high quality business. What are the kind of key characteristics you're looking for there?
Yeah, so always learning as well. But I'll start with like some quantitative stuff that any listener here can apply at any level. So what you're looking for is, first of all, generally speaking, not always, you're going to have high gross margins. There are exceptions to this, which is essentially distribution companies that have growing demand. So an IT distribution company, for example, will have low margins, but could still be quite a moaty business because it's that those low margins actually mean that new competitors are unlikely. And because they're selling IT stuff and we're just like, that's always more spend there, distribution networks, when there's always growing demand, are good quality businesses because you have a fixed asset increasing revenue. So margins can gradually go up over time. But with that out of the way, most of the time, high margins, high net profit margins is a good sign of quality. And now a second one, which will, again, if you do this next step, you'll put you ahead of like 50% or more of other like everyday investors. Calculate free cash flow and calculate free cash flow harshly. So take operating cash flow, subtract all the investing cash flows. They might have made an acquisition or whatever it is, still subtract it. Subtract, nowadays, you have to also subtract the lease repayments because that's basically an operating expense. That's in the financing cash flows. That'll give you a free cash flow number. Take that number and compare it to profit. And don't just do it for 1 year, do it for every year. So the catch with free cash flow is if it's really high percentage of profit 1 year, don't read into it too much. If it's a really low percentage of cash flow 1 year, don't necessarily read into it too much. But track that. And a company that in a normal year, when they're not making a one-off acquisition, when they're just doing either their normal amounts of acquisition or no acquisition, if they are at that point converting profit to free cash flow at high or even better, like increasing rates. So even something as low as if it's an average, like sort of 62%, or that would be sort of satisfactory. That's a good sign that it can be good quality. I think another thing that's quality is you prefer organic growth over acquisition growth. I think that's probably one of the biggest easy markings of how high quality is the growth. Well, is this growth happening because it's a better product that people want? Or is it happening because they're just buying their competitors? Because that's a hugely different quality of growth. Yeah. Because in one case, when there's demand, it's indicative that the product's good, which then might mean they have pricing power, which means that if they continue to have the best product, they can probably increase their margins. They have to spend less on marketing. If they're buying that growth by competitors or adjacent businesses, then every time they do that, they're coming up against somebody else who's run the business for 10, 15 years, who knows exactly what it's worth. Why are they going, sometimes there's good reasons why people sell a business for less than it's worth. But you want to take that bet every time? Like, how many acquisitions are you going to do before some guy is only selling you the business because you've got it drastically wrong? There's something that you think that he knows is wrong and you're offering too much of a price. And the guy's like, well, this crazy guy wants to give me a lot of money. Thanks, mate. I'll do it, And so that would be another key point. Look for the organic growth, not the acquisition growth.
Nice.
And then that goes to the final one, room to grow. And I think in some cases it's intuitive, like Uber is disrupting taxis. So you can look at the taxi market and see the size of it and say, well, that's kind of the total addressable market. Or, ProMedicus has got a better software for, medical imaging. And so you can look at the medical imaging market and sort of think about it that way. But that's like the disruptor where there's an established market. A lot of companies, there's not such like a clean, this is the market, this is the room to grow. So when it's more ambiguous, how do you start to think about it?
I think that the big question when it's ambiguous, it's usually because it's an Australian company I'm looking at and they've like got high market share in Australia already. So they're like sort of running out of room to grow there. And so at that point, you're going to have to, mostly you're looking, sometimes people go into adjacent products and stuff like that. But the more common thing is like, hey, we've got something that sells really well in Australia. Can we sell it overseas? And when you're making that assessment, the main thing you need to ask is, are they already selling it profitably overseas? Because the success rates for a company that has already expanded and is already selling it overseas, they just need to grow that section, is way better than for a company that's like hasn't done it and they might have to make an acquisition to get a toehold in there and get it started, or they're going to launch it in there, because those initial launch costs, like they're often the highest and it's the longest payoff and it's uncertain and stuff as well. And that's the stuff that typically companies do before they're listed. But if they've already done it in Australia, they're going overseas to doing it. That's a higher risk situation there. But it does work like from time to time. Like I think Afterpay is an example that like went overseas and continued to just organic growth there like crazy. And I think one that I actually owned for a while was like Nearmap. That again, like it did the same thing. Like it grew overseas, and even though it did end up taking longer and costing more than expected, they sort of got there in the end. So it can work, but it's a lot safer once they're already sort of going there.
Well, using that criteria off air, you said you've just been spending the last week just going through all things reporting season here in Australia. So what have been some of the key takeaways for reporting season, and have there been any sort of clear winners with the companies that you've been looking at?
I'm absolutely right now thinking about the overall takeaways from earnings season. And I think my first instinct is that it's like we're in a bull market. Like things are good right now.
Nice.
I love that.
Like
in small caps or just general?
Generally, but particularly finally, like the small caps are going, right? So I have no idea how long that'll last. Like I feel like this is probably the first set of reports where a lot of the smaller companies, which are not always tiny, like I consider small really all the way up to $1 billion.
Yeah.
And then, if I've picked a company under $1 billion, I don't sell it because it gets to $1 billion. So
Yeah.
plenty of my portfolio is over $1 billion now. It's just that I've held it from lowest things. I'm seeing, strong results in small caps or the smaller companies, the lesser known companies, and generally speaking, and also like the market rewarding those results like on the day a lot. Like there's a few that they've moved up. So to me, like the feel I get in our little pocket of the market is probably like the small cap funds are doing well. They've got more people investing, so they got more money to deploy, and they've had a bit of good performance now. So it's like, I think we're at that point where, the bottom of the small cap market was 2022. Well, now a lot of the small cap funds or the funds that go in those growth stocks, they've got good results. They can go out there to investors like, hey, I can do like 28% a year or whatever. And like there are some that are a lot less than that, by the way. But like there's a fair few that have got good now. So they're getting more inflows and stuff like that. And so I feel like right now the small caps, I feel like we're having it good already, and I'm cautiously optimistic it may continue. But the reality with smaller companies and the money flows into those areas, and you've probably heard 50 people say this, but kind of what you're looking for always is to get them while they're small, before they're in the indices, before they're widely owned by funds. And then you get that kind of multiple uplift as they get in to the ASX 300, then the ASX 200 are probably the biggest milestones. But depending on how liquid the stock is, even like, world index or world tech indexes, there are actually a bunch of different index funds that like create incremental passive valuation blind buying. And the key thing you want to know if you want to like try and capture this uplift, like first of all, this strategy, you can kind of do it in all seasons. Like it could be a bear market in small caps, but if the company's suddenly like going into the ASX 300 and ASX 200, it can still have a lot of valuation blind money coming into it. And second of all, you actually want less liquid companies for that. Like you want one that is bigger than most companies when it gets into the index. Like you want tightly held ones. You want, a lot of retail shareholders who love the CEO and are long-term investors and they're not going to sell and they're like also valuation blind. And that's how you get these insane PE multiples like with ProMedicus, which is like P of, 300 now or something, is because like a lot of the shareholders are like, me, and they're like, yeah, look, it's very expensive, but it's also the best quality stock in the ASX. And so like, I don't want to like sell the best stock in the ASX. So like, even though it's like, you're offering me a ludicrous price, I'll just sell you a little bit. And it's like, over time I have sold a lot of my ProMedicus shares and most of it far too early. But like, I'm very happy that I didn't ever look at it and be like, 100 times earnings, get out of here. Like, it would have been a terrible mistake. Like, no, people can get crazy. You're going to get crazier than you can ever imagine. If, it keeps a high quality business that keeps performing will just attract more people. And then the value investors can like shout at the cloud as much as they want, but like which is fine as long as you don't listen to the value investor and think, yes, this is the best company in the whole country that's listed on the ASX, but I'm drawing the line at 152 times earnings. Like, yeah, you can sell a little bit at 152 times earnings, but just with the high quality tech stocks in Australia, the phenomenon we're seeing right now is like sociology takes over. Like the need for small cap growth funds and superannuation funds with the growth option. Like every time we play super, yeah, you're in the growth option, well, they got to buy growth ASX stocks. How many growth ASX stocks are there? Like, I don't know, 10 that are like even vaguely comparable. So yeah, like the best one is going to get a lot of flows. And even better if it's like half held by the founders and half held by like, retail shareholders that have been in since $5 and just like are never going to sell all their shares just because like they have an emotional attachment to the stock, which like I admit is probably includes me.
Well, let's stick on ProMedicus. So we said you'd 100 bagged it, but I was just doing the maths as we were talking today. If you held it before you recommended it at the Motley Fool, and the Motley Fool recommendation price was like $1.50,
yeah,
and it's now $300, you've 200 bagged it?
No, so I did the calculations just yesterday. So at a share price of $301, it's for me, I think it works out a 350 bagger from my lowest purchase price. Now, keep in mind, I only put a couple of thousand. Like it was a very small purchase. Okay, it's not like I was putting in tons, but the lowest one was 86 cents, which I looked up. It's pretty vain of me to do. This is my chance.
So that was at the time that obviously met your 3 criteria: high quality business, honest and competent management, room to grow. It has certainly grown.
Yeah.
Still a high quality business and still honest and competent management. But how do you think about it meeting your criteria today? Does it still tick all the boxes?
Well, so it meets my criteria better than ever today, but it's like, well, it's priced in essentially. So I think it's interesting to look back though on what I was thinking, like, because you said it met my criteria when I first bought it, but I don't know that it really did, right? Because, and this is actually my bugbear that's like very triggering for me every time. So like, please don't do this, everyone. Every time someone writes who hasn't actually gotten 100 bagger, someone who like writes a how to get 100 bagger article, like, I don't know if they're micro strokes or what's happening to me, but like something goes wrong with my brain and like, my heart rate starts going like that. And I'm like, calm down. And it's because this technique that people use is they'll take some stock that has 100 bags, like Altium or ProMedicus or whatever, and be like, look at it, and they'll be like, oh, these is the criteria of the stock, and this is what we look for in 100 baggers, like, it's founder-led and it had high margins and sticky recurring revenue, and like all of that is true, but in reality, if for someone who actually got 100 bagger, it doesn't look like that usually. Like maybe it is, but for me, in my experience, most 100 baggers, it's not like, oh wow, this is handy, great company when you bought it.
Yeah.
And so I thought the interesting thing for me is because I've been investing in public for so long and writing my reasons for so long, I can't do that thing, which I'm sure some other guy would do in my situation, which would be like, I am the guy who bought ProMedicus at 86 cents, and I have the special Claude Walker painted in black box, like methodology for like finding these stocks, and I'm going to do it again. So like sign up because like I know how to find these things. It's not like that at all. Actually, what happens, you can still find the first time I ever mentioned that stock publicly on my very first like blog before Motley Fool called Ethical Equities. You can find it was called the microcap health stock watch list or something silly like that.
And what was
microcap? Yeah. Anyway, I sent you guys the link actually,
Okay.
and essentially it doesn't say anything about PME. It was literally as simple as I think that there's a huge tailwind for healthcare as the population grows old, and I think there's this huge possibility for software as all of the on-premise, this is back in these days, it was very much all software almost was on-premise. This is like the very, very, very early days of potential cloud software. Even at this stage, ProMedicus was not doing a cloud solution at all, and it was years away from that. But I could see that software was going to get more and more attractive. So I basically just said, I'm going to, look, this is my exact quote. I said, I thought I'd share my microcap healthcare watch list. Just as an experiment, I want to see if this portfolio of 10 stocks outperforms the ASX All Ords and the ASX 200 over the next 10 years. So I wrote down where the ASX All Ords was in this post, which is on my old archived website, still that line. And then I just said the price of each of them and whether I held them. And I said PME was one, I hold, current price 94 cents. So it was literally, this is how, if you want the truth of how I got a 300 bagger, the truth is I was just like, what's the intersection of two tailwinds? Oh, technology and health. Okay, so I'm going to buy 10 tiny companies, all with a market capitalization of 100 million, less than that. So they all had less than 100 million. They're all tech health companies. Look, a lot of these aren't even listed anymore. They were ICS Global, long since delisted. I think it did okay. Cryosite still exists, and I think it's still listed, but it's gone like nowhere in 10 years. I think it's probably down. Global Health still listed. In my opinion, GLH, not a good company at all. I don't know what the share price is now. When I wrote this list, the share price was 47 cents. Now, more than 10 years later, it's 9 cents.
Yeah, right. Okay.
Yeah. MDG, that went to zero, pretty sure. CompuMedix is actually probably the only other sort of decent one on this list. I won't go through all of them, but yeah, like basically
it's just a classic case of investing though. You get 9 of them that delist or go to zero and one that goes 300 bag.
yeah. So like they weren't all quite that bad, but essentially, so like, yeah, I'm not the guy that like picked the 300 bagger. I'm the guy that picked 10 stocks and one of them was a 300 bagger.
Yeah. But I think that's interesting. You picked 2 trends and you found companies that intersected at those trends, and your thesis was right in a big way with ProMedicus and riding those 2 tailwinds.
Yeah, and so I would actually say that a lot of the style of investing that I was just telling you about, it's not that I had that style of investing and that led me to ProMedicus. It's the other way around. Like I found ProMedicus, started following this story, and then I did what everyone else does and was like get shaped by my own experience. And so I was like, oh, what are the like good things about this company that I like that show? And then honestly, it surprised me what a high quality business was. Like dug in. You know, there was an AGM at ProMedicus. I think the share price would have been $3 or $5. You know, there's probably 20 people in the room or whatever. Me and this great private investor, Stella Wang, who's like, you'll hear her on the conference calls of good companies, just peppered them with maybe 50 questions, like really getting into it, doing exactly what I was telling you about, testing them, like hard questions, trying to find the problems, trying to interrogate, like, what's the weakness in these results? What's the weakness in the company that could be bad going forward? And they like were such good sports about it, answering all of our questions. Some of them were probably silly questions, but just doing as best I could to pick a hole in it. And yeah, in good humor, answering it for ages, still friendly to you afterwards. It was just like such, in hindsight, but also at the time, I was like, already by then was aware that most CEOs, if I like ask them all these impertinent questions, like get sick of it pretty quickly. But it wasn't just the CEO, CFO, the whole team basically, just high integrity behavior. And so then that shaped me and what I look for otherwise, like, you know, outside that essentially.
So when you came on, Claude, in 2021, August 2021, you spoke about Energy One. It's since up 110%. How are you seeing the company today?
Yeah, so I still own shares in ProMedicus and I still own shares in Energy One. And the reason I want to talk about Energy One 4 years ago was because back then it was my favorite, like, new idea that wasn't ProMedicus. So I probably should have just talked about ProMedicus then, but like, I actually don't want to be just like
The ProMedicus.
one
Yeah,
guy.
yeah.
And it's also like, I have bothered for my own sake to like calculate all my returns without ProMedicus. Like, I'm like that guy in the meme looking at the mirror. It's like, you're not just a one-hit wonder. Like, you have actual skill. It's not just luck. And so, like, that is the case. Like, I still outperform without this one stock, but obviously that is the biggest contributor is ProMedicus. But Energy One is now, I'm hoping, going to be a big contributor to my returns going forward. And I've actually done something which I did not allow to happen for many years, which was I allowed another stock, not ProMedicus, to become my biggest, largest single position. And that stock today is Energy One. So it's still, in my opinion, like, from what I look for, from what I can tell, it still remains a very attractive business. However, what has changed the most of all is the share price. And I wanted to like kind of share what I went through in the last 4 years. Because what happened is it just so happened that at the time that I spoke about Energy One on the podcast with you guys, like, first of all, it was on a little bit of a run. Like, it was more or less close to, I can't remember, I'm not looking at a chart, but I think it was like at that time maybe close to an all-time high. Like, the momentum was good. And then what happened not long after that is like everything went wrong. Like, they had to invest in cybersecurity a lot and they got like cyber hacked and someone tried to like extort them and stuff like that. So that was like bad news. There was, a contract that they spent a lot of time and effort trying to win that they didn't win. And there was also then, when the share price dropped to like below $4, an opportunistic takeover offer, where someone else came in, like a private equity people came in, try and like basically take advantage of this bad stuff that had happened to buy the company as cheaply as possible. They were trying to take it over at $5. They lowered their bid eventually to $5.11. So this whole time, I'm like, I've gone on Equity Mates. I've gone and talked this stock up at, I can't remember the exact price, but it was like $5 to $6. And now everything's gone wrong. It's $4. And yeah, look, I might look okay when I like appear on whatever it is to talk about stocks. But inside, when I think about things like that, I'm like fetal position. I'm like, oh, what if some guy like bought stock and now he like hates me and he doesn't know what to do? And like, I mean, hopefully that's such a person. Like I was making at that stage, I like made some of my coverage like free to read. So if people could like actually found it, they could still know what I was thinking. But like, it felt so bad. And like, that's actually the worst thing about this job for me is I can't escape the like emotional turmoil of when things go wrong. And like, it would be fine if it was just my money, but it's just like when I've tried to help other people and it's like actually made some bad luck's happened or I've made a mistake, which both things happen. And then I'm just, and so it just took so long to come good. And that whole time, like, it's like that, like, I wasn't guilty because I don't think I'd done anything wrong, but it was akin to that guilty conscience. It was like this thing that I like felt regret or like not regret, but like I felt so sad that I'd chosen one stock to come and share with you guys. And because you guys so clearly want to like help a broad audience, I have so much admiration for that. I was like literally trying to do the best I could possibly do. And then, it would have been nice if it just went straight up. And then instead it goes down. And now, it's $12 or $13 or whatever it is. And so much has happened. And I guess like the update there is the reason that stock price has now finally like gone up to where it is today is because essentially it finally put out a clean set of results that weren't impacted by some like one-off thing that happened. And so that profit number has suddenly gone up and it become a lot more obvious to people how profitable this is as a software company. So I should probably say what it does. It sells software and services for energy trading. So if you're a big participant in an energy market, like a power plant, you can just buy the software and you can employ the energy traders to use the software 24/7 to dispatch your power. Or if you're a smaller energy generator, like a new wind farm or a solar farm or a battery or whatever it is, you don't want to have to staff 24/7 energy trader because you're just not big enough to justify it. So they'll do it for you. They'll have the service where they'll do the 24/7 desk. So in theory, that's where they're supposed to, over time, I would hope, continue to get improving margins because they've invested in having this 24/7. They've got a desk, I think it's in Brussels and in Adelaide. They've got sort of energy trading desks so that they can just do 24/7, but they don't have to pay someone to be up at 3 a.m. And so in theory, as we get more wind farms and solar farms and various different kinds of generation, you're going to have more demand. There are more kinds of power plants that don't just want the software, they want the whole software services situation. And these guys have, 50% market share in Australia or more and less in Europe, which is where their other geography is. But they're making good money from both places. They have bought a few acquisitions over the years. And part of what I guess like put the share price down was they were sort of digesting their, at that time, biggest acquisition that they'd made. And so, yeah, essentially, if it's the same, the reason I'm trying to talk about this stock, and I could be wrong, is it's the exact same mental process that I went through. Like, I'm not that smart. I'm like, oh, what are the trends? Oh, yeah, there seems to be more solar panels around or solar farms and wind farms, right? Everyone's talking about that constantly. I think there's going to be more of that. But like looking at the economics of investing in a wind farm doesn't seem like I'm going to get a great stock. But, you've got that same software tailwind. Like the software is doing more and more and smarter stuff. And I see the opportunity for software to do even more in energy networks as they become more complex. It's like not just one coal plant that's on or off. There's like so many moving parts. Well, surely the software becomes more important. And if something's becoming more important, surely it has more pricing power. So that's the long-term idea. It's the very similar, simple crayon kind of idea that led me to ProMedicus is what led me to Energy One. Now, I should hasten to add, I first bought shares in Energy One at $1, right? So it's...
So you've already 10 bagged it.
Yeah. No, but that was my lowest purchase. After we did that podcast, it's 1440 and we're talking. After we did that podcast, I bought shares, by the way. Yeah. So like, I want anyone who went through that roller coaster with me to know I was there. Like I paid way like $6 or $5.80 or whatever for shares after that podcast and bought most of my position after that podcast. So my average price is not $1. It's way higher. But so that is sort of where we landed with that. But also I just wanted to like basically tell that story of what a emotional roller coaster small cap investing can be. Like there's only some people want to do that essentially. And if it's not for you, fair enough. Like I don't even know if it's a good idea. Like the emotional tax and the cost for some people would probably be not worth it. But for me, like I guess something draws me to that excitement.
Well, Claude, we are unfortunately out of time, but we will definitely get you back on because a lot of the Equity Mates community love hearing about opportunities in the small cap space. But if anyone wants to continue the roller coaster with you, what's the best place for them to keep track of what you're writing about?
Well, what I would love most of all, if people check out our new YouTube channel, the ASX Small Cap Wrap, and that I just wanted to have something that was just talking about small caps. So it's very nerdy. It's like it's nothing like this podcast. It's just literally I will say what say what the profit is, review the results. Like it's very nerdy. Like for the people that actually diving down. Like I think the last episode which we just published, I'm like talking about how I'm going through the footnotes to see what the adjustments are to the to the underlying profit and stuff like that. So I'm going through the process, the nitty gritty of how I analyze small cap results to like form an opinion on that, I guess. So it's for, small cap nerds, but that's basically like my latest new project. And then of course that is part of and leads into our website, A Rich Life, which is like our actual business where we, if you sign up, you can get free emails, or you can join the wait list, or you can even subscribe if that's what you want to do. But again, very niche for people who are actually doing this small cap investing stuff and reading the reports themselves and everything.
Awesome. Well, we'll include a link in the show notes to the ASX Small Cap Wrap YouTube channel.
Thank you.
Check it out.
Some great album artwork.
Yes, I'm having a
what
look
do you
now.
call it? Podcast art.
Thumbnails.
Hey, we're just starting out, guys. We got like 300 views on our
Yeah,
videos.
I'll definitely check it out. But Claude, thank you so much. It's always a pleasure chatting, and we wish you all the best with the YouTube channel, and we'll get you back on soon.
Yeah, thanks for having him. Like, keep doing what you're doing, guys. Like, it's so it's like it's so important in the way we've structured society that people do participate in capitalism, even if your political views might be like, this isn't how we should structure society. Like, better to participate than to suffer, in my opinion. So good on you. Like, what you're doing is like really good, and I have like so much admiration for what you've achieved in the last 4 years as well.
Thanks, Claude. We appreciate that.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.